Go. Keith Frelicker is the grossest person I've ever met. When I looked at his feet, I thought I should see a vet. Oh. Put your socks on. It's time to put your socks on. Pete, put your socks on. It's time to put your socks on. Keith Frelicker.
All right, so everybody open volume 1, page 1. Sam, who you want to call on? Just what the next thing that's coming. Yeah. AKA Jack. Okay. Jack? Okay, I'll stop because that's going to get confusing. Thomas, what's page 1 say?
Checkpoint contents.
Yeah, in the red box.
Application of subchapter C rules, except as otherwise provided in this title and except to the extent inconsistent with this subchapter. Subchapter C shall apply to an S corporation and its shareholders.
Okay, what the hell does that mean? And why are we here?
No.
What is this really about?
Transfer of knowledge.
That's right. What knowledge is being transferred?
From you to us, so you can retire.
Jeez. We're talking about S-corps.
Oh.
Okay, this is all about S-corps. So, given that is our lens, Thomas, what does that mean?
This 1371 just applies to S corps and its shareholders. All the rules in 1371.
How do you feel about that, Benjamin?
I think you nailed it.
I think you're both wrong. Okay? So what 1371 says is that all subchapter C rules, all corporation rules apply equally between C corporations and S corporations. Okay, so except as otherwise provided in this title, except to the extent inconsistent with this subchapter, subchapter C, which means all C corp rules apply to S corps. Okay? So, me being me, this is my view of it. Okay? It says rules under subchapter C apply to S corps and C corps. Code section 351, which we're going to cover today, which is, and when we cover this, we're going to recover it, and we're going to recover it, so you might want to pay attention. Okay? 351, which is corporate formation. 331, 336, which is taxable corporate liquidation. 332, 337, which is tax deferred corporate liquidation. You might want to put a circle around that one, because when we talk about Q subs later in the lecture or whatever we have, 332, 337, 334 are code sections that we're going to apply to Q subs, and Q subs are all part of the subchapter S rules. 368 are corporate reorganizations, spin-offs, F reorgs, so we use F reorgs all the time. 302 is corporate redemptions. So everything in that circle is 1371 says that all those rules apply equally both to C corporations and S corporations. Everything outside that circle, 1361, 1368, 1367, 1374, 1375, those are the exceptions. Those are rules that only apply to S corporations. 1361 is the rules associated with who can be an S corp, what are the rules to be an S corp, what are the barriers to be an S corp. We'll be talking about that. 1368 are the distribution rules. Those distribution rules, as a preview, you might want to write down, just because this is something we're going to cover, is that you have two categories of corporations. The first category is corporations with earnings and profits or previously a C Corp. And the second category is corporations that don't have earnings and profits. So there's going to be two subsets that we have to contend with in 1368 for distribution purposes. And there's a whole section on distributions toward the end. 1374, I can't remember whether that's the built-in gains provision or whether that's passive. I think it's the built-in gains provision. We're going to be talking about that. 1375 is the passive income tax. We're going to be talking about that. So everything in the first circle, 351 applies to both S corporations, C corporations. In the second circle, 1361 only applies to S corps. So, Thomas, what 1371 says is 351 applies to both. It coordinates back with subchapter C. Okay, so let's go back to this and see what I care about. Okay, you care a little bit about this, and you might want to take a note about this. And if this is something that if you remember in the future when you have a corporation that converts from C corporation to S corporation, the corporation can have an NOL. The C corporation can have an NOL. When you convert from C to S status, that NOL, it doesn't disappear, but it's not useful. It is useful insofar for a built-in gains tax calculation, but that's about it. And we're going to talk about built-in gains tax calculations. Thomas, who do you want to call on?
Jameson.
Jameson, what's the little box say in C1?
A converted C Corp may have C Corp earnings and profits. The earnings and profits may affect certain S Corp operations.
Okay. Do you remember what earnings and profits were, Jameson? Did we talk about that in one? Jimmy says yes.
We did?
Yeah. What?
Well, Jimmy knows what they are then.
Well, Jimmy, what are they?
I don't know much.
Do what? Are they?
Yeah, I'll let Jameson get a point back. So.
Do you know what they are or not, Nicola?
Not that I remember off the top of my head.
Okay.
There's what, like 3 of them?
3 of them. No, there's only one of them, Jameson. Or Jameson. Whatever, Nicola. Okay, so earnings and profits, right, is if you have $1,000 earned by a C corporation, okay? And the C corporation has a 30% tax rate. That means there's $300 of tax, there's $1,000 of cash that came in, there's $300 of tax, there's $700 that's in the corporate bank account, okay? As a C corporation, the corporations earn dollars and it's paid tax on those dollars and they are undistributed, okay? And again, going back to 1371, it says all C corp rules apply until they don't, okay? So if you have a C corporation that converts from C to S, it's going to have probably earnings before it converted, correct? And it's probably going to have those earnings that they're undistributed, correct? So what this says, except as otherwise provided in 2 and 3, in D3, no adjustments can be made to earnings and profits of the S corporation. So when an S corporation converts, it's converting, and it's going to convert with this EMP. And it says S corp operations are not going to adjust earnings and profits. Now, why are we bringing that up? Because 1368, what did I tell you to write down, Jameson, on 1368?
1360, the distribution rules.
And but there were 2 categories.
Oh, there's Corp with EMP and Corp without.
Corp with EMP. So the Corp with EMP is a C corporation that earned its $1,000, paid its tax, and has $700 of earnings and profits when it converts, okay? And when you talk about distribution rules later, you have to know what this earnings and profits numbers are to run through the distribution rules that we're going to talk about later. Subchapter C shall apply unless there is an exception. Okay? And one of the things that we talked about on that circle, first circle lane was what? 351, right? Okay? So 351 are my corporate formation rules. And under my corporate formation rules, Lane, how many code sections do I have with an asterisk next to it?
What are you talking about?
Right up here.
Oh,
Okay.
1, 2, 3, 6.
6. Now, Jameson,
Isn't
There's
there
just-
7?
No.
Oh, there's 1 and 2. Or what?
Yeah, there's 2 6s.
huh?
It's the same code
It's the
section.
same, yeah.
Which one?
23.
Oh, I see.
1223 is 1 and 2.
Yeah, but both are applicable. One, and we'll get to that. But the one that I missed one, is 168 I-7 when I wrote this. Okay, and when you write down 168 I-7 in your material, write down that that is depreciation, a step in the shoes for depreciation purposes.
Can we just ignore that rule?
Absolutely not.
Does Snyder ignore that rule?
No. No, he ignores 1239, but we were being recorded and we're not going to talk about shit we ignored.
I forgot about the mics.
So now we're going to hammer on 351, and we're going to hammer on it pretty hard. Okay? So what you need to develop, let's see, who remembers? I'm going to ask a couple questions. Lane, who would you like to call on? Anybody but Sam.
Thomas.
Thomas? Are we here to be experts, Thomas?
No.
What are we here for?
To learn.
To learn, right? To be able to spot the issues and hopefully have enough, to take enough away from this that either you're cognizant of it or hopefully be able to execute on this when it comes up again. Okay? What are we drinking from, Brett?
Fire hose.
Fire hose, right? Because the amount of information that's coming at you is a lot. Okay? So, what you need to learn from this page or this particular piece is that when somebody says 351, for me, when somebody says 351 corporate formation, 351 does not act on its own. 351 says 351 occurs, which is corporate formation, which we'll come to that. But when 351 is turned on, then 357C is turned on. And 358 is turned on. 362 is turned on. 368C is turned on. 1223 1 and 2 is turned on. These are what you call running through the traps of corporate formation. And so, in 168 I-7, it's turned on. So, let me ask a question. Who was the last person? Thomas? Who do you want to call him, Thomas?
Emma.
Emma? Have you ever had or heard of anybody saying we want to file a 2553 for a partnership or an LLC tax partnership, which is the S-Corp election? You have not. Has anybody? Dissler has, right? Okay. Are you really the only one?
Probably have.
Do what?
Probably have sometime. but-
Okay. How often does this happen?
Frequently.
Frequently. Okay. So if you have an LLC that files a 2553, what happens? What is that? Trent?
This corp election?
An S-Corp election. But it's an LLC taxes partnership, right? Yes. Okay.
Could also be an LLC taxed as a single member LLC Schedule C.
Sure, 100%. And so, let's talk about this for a second. I don't particularly like that. See if red's better. Yeah, it's better. Okay, you have an LLC with land has basis of 1,000, fair market value of 10,000. Okay, Sam, an LLC without a check the box with two people is taxed how?
Without a what? A check?
With check the box
What do you mean check the box?
to be elected as a corporation.
Oh, how are they taxed?
Mm-hmm.
Well, if they like to be taxed, then
They haven't elected anything yet. They have not.
taxed through K1 to the partners.
It's a partnership, right? It's a default to a partnership. Two-member LLC defaults to a partnership. Sam, who owns the ground legally?
The partnership.
The partnership. Generally, I'm asking obvious. There's generally
Yeah.
not a trap.
Yeah.
Okay.
Okay.
So the partnership, and see, if Lane was nice, she would have said they're not traps. Just answer the question. She just said,
We
what
have
was
to
your
go
advice?
through it, you know.
I don't know. Yes. And the answer, that was a good piece of advice. There's two answers, right, Lane? What are they?
I don't know, and it depends. No, I don't know in the right answer.
I don't know and the right answer, right? There's only two answers in the world. I don't know and the right answer. Okay? So, the land is owned by the partnership, X. Then comes to you, Sam, and says, hey, we're tired of self-employment tax. We want this to be taxed as an S corp. So, we check the box. Check the box, meaning the partnership now is electing to be taxed as what, Sam?
Well, you said an S corp.
A corp. Okay? But the 2553 tells them that we want to be an S corp. Okay? And we're gonna cover this hard later. So this is like a first dry run at what's happening. Okay? So when you go from partnership solution to corporate solution, do you think that you're in corporate formation rules?
Yes.
You are. Okay? Who do you want to call him, Sam?
Tatum.
Tatum. Oh, Tatum. Why do you look so terrified, Tatum? You're used to me by now.
I'm always terrified.
Why?
Because you're scary. You call on me sometimes. I'm not paying attention.
No, well, wait a minute. Whose problem is that?
Me.
Okay.
It's still scary.
As long as we can recognize whose problem that is. Okay, so when we know we're in corporate formation rules, how many code sections do we have to run the traps on?
6,
7,
7.
because we forgot about 168.
Oh yeah,
And what are
it's a
they?
trap. You want me to list them?
Yes. I do.
351, 357C, 358, 362, 368C, 1223, 1. Oh no, 1223, 168I, 7.
Okay. So what these rules say, okay, 351 is the basic requirements, and we're going to cover this. But 351 is going to segregate the transaction into whether it's a taxable transaction or a tax-deferred transaction. Once we figure out it's a tax-deferred transaction, then these other code sections kick in. So you might want to write on this page, or if it matters to you, this is your journey through life, that 357C, 358, 362, 368C, 1223, 1, 2, and 168I7 only apply if it's tax deferred. Okay, because again, let's see, Emma, are we doctors?
No.
But what do we do?
Diagnose.
We diagnose. And how do we diagnose? By running through the rules, right? So 351 helps us diagnose whether the corporate formation rules tells us whether it's taxable or whether it's tax deferred. And then once we know that it's tax deferred, at that point we got 357C, 358, 362, 368C, 1223, 1, 2, and 168I7. And why do I keep running through those?
So we remember.
Yes, but for me, that's my checklist, right? That's how I know what traps I got to run through to, what do I have to do, Emma?
Diagnose.
Diagnose what's going on. So you might be, however, this is how my memory works. I can remember those numbers, and now I have a checklist on what I need to do to, Emma?
Diagnose.
Diagnose what's going on. For you, you might say, well, 351, well, you might go corporate formation rules. Okay, there's 3 elements of the corporate formation rules. Then 357C for me is debt in excess of basis. 358 is what is the shareholder's basis in their stock that they receive from the corporation. 362 2 is what is the basis and the assets of the corporation. 1223 1 and 2 is what is the holding period of the stock. 1 is the stock in the shareholders' hands. 2 is the holding period for the basis and the assets of the corporation. And 168I7 is saying what's the depreciation schedule that exists on the corporation's balance sheet. And 368 is control. Okay, so however you need to remember it, or if you check the box, right, and you have partnership X, that Ben comes to you and says, hey, I want you to file a 2553. I want you to make this partnership, this LLC taxes partnership, an S Corp, and you need to file your 2553. 2553, even though the land is owned by the partnership. It's titled to the partnership. We agreed on that, Sam, right? Okay? But you still got to run through these rules as if it's not titled to the partnership. Because under tax purposes, for tax purposes, from a transactional purposes, even though it doesn't exist in the partner, it exists in a partnership legally, it has to somehow move into a corp. And that's a tax fiction. And somewhere on there, I don't know where, it's down below, it's Revenue Ruling 84-111 is going to tell you how it's going to move from the partnership over into the corp. And we're going to be covering that.
Hey, can we say out loud that this is a bad example?
What is?
Having land that we're putting
Sure.
into this corporation.
Why is it a bad example, Ben?
Because
Did I give Ben a point because I'm an idiot?
we,
Okay, all right, we'll give Ben a point.
we never put land in a corporation. So if somebody comes to you and says, I have land in a partnership and I want to incorporate, you should tell them no.
Or retitle it out before you do.
Right.
And why is that, Ben? Did you say it and I wasn't paying attention?
No.
Why? Why is it a bad idea? Because it's a great point. We might as
Because
well.
if later on they want to do some type of restructuring and pull the land out of the entity, when the land comes out, it's going to come out at fair market value as a deemed sale. And so you have taxable income and no cash, so it's a bad answer.
Okay, so let me put my spin on this. You know, putting stuff into a corporation, okay, checking the box or physically putting it in the corporation is like buying a house or getting married, right? It's easy to get into. But getting it out is costly and painful. So once it goes into the corporation, it is trapped. And what Ben just said is if I want to extract that piece of land out of that corporation, the basis, the fair market value of that land is $10,000. Basis is $1,000. By virtue of pulling it out of the corporation and putting it into the shareholders' hands, is a taxable event. It's as if the corporation sold the property. Ben, for another point, what code section is it? You might not.
Is it on the board?
It is not. It's below where you can't see.
Oh, liquidations.
Nope. Hold on, that's different. But that's also true.
I don't know.
311. And we're going to be talking about 311 too, because what's 1371 say? Lane, who do you want to call on?
Lucas.
Lucas, what's 1371 say?
Where are we?
Okay. Call on somebody else.
Trent.
What's 1371 say, Trent?
I was just looking for that.
Isn't it
Front page.
when S corps are taxed the same as C corp or treated the same as C corps? The rules.
All C Corps rules apply to both C and S Corps. 311 applies to both C and S Corps. The point that Ben's bringing up is once you get into corporate solution, 311 applies equally to both subsets. And once you put land inside the corporation, 311 says you aren't getting it out without it being taxable. And also 336 and 332 say the same thing. So there's different subsets of that. Lucas, what's number 2 say up here?
Corporate liquidations. Read the whole thing?
Mm-hmm.
All right, taxable liquidations, we've got 331, shareholders' consequences, and is that 336?
Yep.
Corporations' consequences, and then tax-deferred liquidations, 332, shareholders' consequences, 334, shareholders' basis in assets received, 337, corporations' consequences.
Put a circle around that. Put a circle around the tax deferred. Now, both are wildly important, don't get me wrong. But when you put a circle around that, inside that circle, you might want to write Q sub consequences. Because these are the corporate provisions that dictate what happens when an S corp turns into a Q sub. So we're going to be covering this pretty heavily at some point. What's number 3 say, Lucas?
Organizations under 368, mergers, spin-offs, split-ups, etc.
We don't care about that for this class. But any sort of corporate reorganization, the most likely one that you guys would see is corporate reorganizations under 368(1)(f), which is called an F reorg. And go back to the circle. What did we just circle, Jameson? But what did we write in terms of why do I care? Q subs. A Q sub? Yeah, we're going to cover this, but now Jameson's taking me off course. No, you're okay. And she wants to know what a Q sub is. And we're going to talk about this too. Is a Q sub is when, okay, you have X, I'm going to make it X Co. And it's owned by Jameson. Okay? We're going to talk about Jameson owning Xco and the rules that allow Jameson to treat Xco as an S corp and not a C corp. And there's 5 or 6 or 7 different characteristics that we're going to cover. A Q sub is Jameson, this is an example, this is not the only example, decides that Lucas owns YCO. And YCO could be either an S corporation or it could be a C corporation. I don't care for the purposes of this discussion. Jameson says, hey, I want to buy YCO. So Xco buys YCO. And now Xco owns 100% of YCO, which I have Xco and Xco, but I don't care. So now, one of the rules says that an S corporation can only be owned by an individual. So if it's not owned by an individual, and we're going to cover this, it can't be an S corporation. Is Xco an individual? It's not. So the Q sub election says, hey, if you have an S corp that owns 100% of another corporation, it can make something called a Q sub election. And the Q sub election says that YCO becomes a disregarded entity, a DRE. And let's see, Kaylee, what's disregarded entity mean?
So it means that for tax purposes, it doesn't exist.
It doesn't exist. Who owns the assets for tax purposes?
Exco.
Xco. So, before we did the transaction, Lucas's corporation owned land, which is a bad idea, right? What do you want me to put in there, Ben?
An operating entity?
An operating entity. I'm still going to stick with land. It's easier to write. Okay? So you have land. Xco still legally owns land. So What 332, 334, 337 says, you have a corporate consequence, you have a shareholder consequence, and you have to measure basis. The corporate level consequence is there's a distribution. Who owns the land, Kaylee? When the dust settles at the end?
Tax purposes or legal?
Who owns it here?
There, oh, Wyco.
Wyco. Who owns it when this becomes a DRE?
Exco.
Exco. Which means, for tax purposes, there had to be a distribution of the land out of Exco, or Wyco, correct? And does Wyco exist anymore?
Not for tax purposes.
Not for tax purposes. That means Exco technically had to surrender Wyco stock, and it no longer exists. Okay? So the deemed distribution of the ground is the corporate consequence. 337 measures the corporate consequence of distributing that ground. The surrendering of Wyco stock measures, the consequence is measured under 332. So, Kaylee, for tax purposes, who owns the ground?
Exco.
Exco. 334 is going to tell you what the basis is in that ground. So when you do this Q sub election, which I do with them all the time, this is a part of my world all the time. So this concept is something I use how often, Jameson?
All the time.
All the time. I use 331 and 336, but those are taxable liquidations. We're going to talk about it. We're not going to hammer on that as much today because are we here to be experts, Thomas?
No.
We're here to learn, right? We're here to raise awareness. So we're going to grab as much as we can, bring it along, and know that other things exist and that we don't have a full universe of all the rules. Okay. Lucas, who you want to call in?
Oh, Jack.
Jack, what's 4 say?
Stock redemptions. 302, redemptions interact differently with C Corps, S Corps with C Corp earnings and profits, and S Corps with no earnings or profits.
That is so staggeringly complicated, but we're going to get to it. And so when you hear the word redemption, Jack, what does that mean? If I say there's a redemption, can you explain back to me what that means in terms of the transaction that just occurred?
Would be if basically you'd be purchasing stock back and somebody would be getting
Who's
cash
purchasing it back?
The owner of it.
Who's the owner? Okay, now I'm not being a jackass here, right? Because this is like a term of art, and we need to understand the term of art. So you were on it, you were so close, and then you just kind of veered at the end. So it's a purchase of stock. That's true. Who's the purchaser? Who's the purchaser? Okay, so Exco is owned by Jack or whoever. Exco redeems, or it was Jameson, right? Whatever. Hey, now you're paying attention. Okay, so if Exco purchases back stock from Jameson, that's redemption. So the entity who issued the stock is buying back their own stock. That's redemption. Redemption rules are covered under 302. And actually, are we experts? We're not. Unfortunately, this is trending more towards expert material. I mean, the thought process associated with 302. And if I, to the extent I can make that not true for you, the better. I use redemption rules in an S Corp to my advantage sometimes. And when I use them to my advantage sometimes, it's a good thing. So let me give you a 50,000 foot view of how I use them to my advantage. What was the definition of redemption, Jack?
Buying back stock.
Who?
Business.
The business, the company. So let me ask a stupid question. If you have stock that has a fair value of 10,000 and a basis of 1,000, how much gain do you have embedded in that stock?
You have 9,000 again.
9,000. 9,000 a gain. So if you sold half those shares to Thomas for $5,000, what's your gain?
4,500.
$4,500. So the act of selling stock generates gain, right? The redemption is what again?
Business buying back stock.
Business buying back stock. So did you sell your stock?
How do you mean?
You sold your stock. You sold it back to the business.
Yeah.
So if you sold 5,000 back to the business, what's your gain? There were two answers, and you said a third one earlier. Depends, right? It depends. 302 is going to tell you what just happened. So 302, you sell it to a third party, you have a stock sale. When you have a redemption, and this might be important to write down because it seems important to me in the moment, is a redemption. Who's my diagnosed person? Who? Okay. What do we do?
Diagnose.
Diagnose. 302 helps you diagnose whether you have a sale or exchange of the stock or whether you have a distribution from the company. Okay, so that I use all the time. But again, those rules they're complicated, or they're more complicated.
So a redemption is treated as a distribution.
It can be. So let's talk about that for a second. Why not? Because I go down rabbit holes all the time. And I don't know how much we're covering later, and I really don't care because I meander all the time. So how much was our earnings and profits for Exco earlier?
700.
$700. Okay. So the corporation's already paid tax on that, correct? And let's say that we have Jack this time, because I'm going to continue to be confused, says, I want my $700. And it's a C Corp. If the C Corp distributes out $700, what is that? Sam?
Be a dividend.
It'd be a dividend. And my dividend tax rate is how much? 30%. Between state of 7% and 20% for federal and 3.8% for NIT, let's call it 30%. Okay? So 30% of 700 is how much? $210.
Okay.
Okay? What was that, Lane?
I need a calculator. I'm bad at mental math, as we all know.
I think I remember that.
We all know I'm bad at mental math.
I didn't remember that, honestly. So if we do a dividend of 700, I got a $210 tax. Well, what if I have basis on the outside of 1,400? And what if, how do you define a corporate redemption, Jack?
Business buying back their stock.
Business buying back their stock. So what happens if Jack says, I got 100 shares. I'm going to sell back 50 of those shares. And the fair market value of the company happens to be equal to 1,400 too. Why not? Well, I sell back 50 shares, 50% of the company, right? How much cash comes out? 700. Okay? So I have 700 of proceeds. What's my basis? Do I get to use basis? Do I still have my shares?
Well, you have half of them.
Do what?
You have half of them.
I have half of them, but did I sell my shares? Nicola says yes. Jack says yes. Trent, what's 302 do? Help us what? You're supposed to say
Diagnose.
diagnose.
Sell stock or distribution.
Whether it's distribution or sale of stock. Okay? How much did Jack own How many shares did Jack own prior to the redemption? How many did he own after?
50.
What percentage did Jack own before the redemption as a percentage?
100,
100. How much did he own after
50,
as a percentage? 100. He owned 100% pre, he owned 100% post. So instead of declaring a dividend, why can't I just sell back 50 of my shares, get basis of 700, and have no gain or loss? That seems way better than a $700 dividend, doesn't it? But how much did he own prior, percentage-wise? 100. How much did he own after?
100.
Did he find a way to get earnings and profits without paying a dividend? Does that seem like the IRS would smoke that one out? And they wrote a provision to diagnose what? Whether it's a sale or exchange or a distribution. So since Jack owned 100% before and Jack owned 100% after, they don't care that you surrendered shares. They call it distribution. Okay, so that's what 302 does. It helps you diagnose when there's a redemption. When a redemption is called what, Jack? How we define a redemption?
Business sale of stock
Business sale
or purchase.
Sale of stock back to the business. And 302 does what?
Diagnose whether you have a sale of a stock or a distribution.
So when you have a redemption, you have to go to 302 to diagnose. That's what 302 is about. Okay, let's see. All C corporation. Let's see. Redemptions interact differently with S corps, differently with C corps, S corps with C corps earning profits, and S corps with no earnings and profits. All that's true. It's way too complicated. Just know that it's true. All corporation rules apply with the exception that were created for. Oh, what's the point? I don't care. We've already talked about that. Let's see. Who did I call on last? Was it you, Sam? Did I pick on you last?
Yeah.
You seem very happy about that. Who do you want to call on?
Jimmy.
Jimmy, how many codes, if I say we're dealing with corporate formation, how many code sections do I have to run the traps on?
7.
Seven-ish.
Yeah.
Okay. And the first one is 351. And what's 351 help us diagnose?
The basic formation of basic requirements.
Anybody want to help Jimmy? What's 351 help us diagnose?
Is it whether the other ones are turned on? Is it whether you turn on the other?
Yes, but you helped them all out. Do it again. What did that mean?
Taxable and tax.
Whether it's taxable or tax deferred. Okay? So 351 helps us diagnose whether it's taxable or tax deferred. Let's see. Oh, look at that. It even says it. My God, I got ahead of myself. I always forget the stuff I write down. Kaylee, what's number 2 say?
Is section 351 a mandatory analysis or optional? It is mandatory. When property is transferred to a corporation in exchange for the corporation's stock, the section 351 analysis is mandatory.
Okay. So 351 is mandatory. You don't get to opt in or opt out of it. Let's see. Let's just take the guided tour because I don't even remember what the hell I said here. Kaylee, who you want to call on?
Natalie.
Natalie, how are you?
Good, how are you?
Good. You nervous?
Yeah.
You are, I can tell. Do you want to pass it off because you're nervous, Natalie? Okay, what's this say?
If section 351 results in a tax-deferred transaction, what is the general procedure? You have to measure whether debt was transferred to the corporation. If debt was transferred, was the face amount of debt in excess of the basis of assets transferred? 357C. Measure Measure
basis.
the basis of the stock received, 358. Measure the basis of the assets received by the corporation, 362. What is the holding period of the stock received, 1223? What is the holding period of the assets received by the corporation?
So for a point of clarity, what do I mean by holding period?
How long you've held the asset?
How long you've held the asset, and why do I care?
I don't know.
Because there's different treatments between short term.
Yeah, you got to measure whether it's short term or long term. 100%. So, what I want you to highlight on this page, and we're going to hammer on this or take a note of it on this page, is you start with 351, and you start with 351, Trent, why?
Diagnose.
To diagnose what exactly?
Taxable or tax deferred.
Whether it's taxable or tax deferred. So, once you determine it's tax deferred, there's an order to this. And the order, and we're going to hammer on this as we go, is 351 is used to diagnose whether it's taxable or tax deferred. The next section you go to is 357C. There's an order, and you have to go to 357C next. Because going to 357C, you have to measure whether you have debt in excess of basis of the assets contributed. Now, I don't know how much we're going to hammer on this later, but we might as well give a little bit of a preview. Because again, at the end of the day, like I said, I'm taking the guided tour. I don't remember what I wrote. I just printed it, put it in here, and I don't care how many times we cover it. So, Trent, who you want to call in?
Jimmy.
No, hold on. No, do we have a conspiracy already?
Not yet.
Not yet? Is there a conspiracy, Jimmy? I mean,
It was last session, yes.
there was.
Yeah.
Do you not think Jimmy can answer the question?
No, it just keeps going to Jimmy. Like you were part of that conspiracy last year. No, you weren't. Who was? Do what?
To himself.
He did it to himself?
Went to Omaha State then.
Well, when you took a vote, no,
It was Emma's idea, though.
No, it wasn't. We worked through this. It's like on Tito, he's not here.
no, we're not blaming Tito's. We're not blaming Tito's. Okay, Jimmy.
Yeah.
If I spot a pattern, we're going to put a stop to it. But that doesn't mean stop calling on Jimmy. But if I spot a pattern, Jimmy gets picked on. Jimmy, what's debt in excess of basis mean?
It means what you just said.
Okay, tell me. Give me an example.
I don't know. I don't got one at the top of my head.
Okay, what
So the basis of the land was 10,000
no, it's 1,000.
or 1,000. The fair market value is 10,000.
So what would debt have to be debt in excess? Land. Fair market value was what, Jimmy?
1,000. Or
10,000.
fair market with 10,000, yeah.
Basis was what?
1,000.
1,000. What would my debt have to have a 357 problem or kick in?
The 11,000?
Or 1,100.
Yeah.
But it could be 1,001. It could be 10,000. Doesn't matter. It's going to be in excess of basis. My debt is in excess of my basis. So 357C is a starting point, right? 351, Trent helps us do what?
Diagnose.
Diagnose what exactly?
Taxable or tax deferred.
Taxable or tax deferred. And if it's tax deferred, your first stop is where?
357C.
And 357C, Jimmy helps us diagnose what?
Debt in excess of basis.
Debt in excess of basis. Okay, so if we have debt in excess of basis, what 357C says is to the extent the debt exceeds basis, you have a gain. How much gain do we have if we have 1,001 of debt? 1. If we have 10,000 of debt, how much do we have? 9. Okay? So, this debt in excess of basis, the reason we stop, or the reason we first diagnose whether it's taxable or tax deferred, and then we use 357C to diagnose whether we have debt in excess of basis, is I want to know if that gain number exists. That gain number affects 358 and 362. Jimmy, who you want to call in?
I'll go Chambers.
Jack, what is, going back to whatever page, what's 358?
Basis and shares received.
Basis and shares received. What is 362?
Basis and asset received by the corporation.
Basis and the asset received by the corporation. So we started 351 to what, Trent? Diagnose taxable or not. Then we stop at 357C. Why, Jack?
Debt in excess basis.
But why do we stop there next?
The gain.
To see if there's a gain. Because when we drill down into the formula for 358 and 362, the formula, part of that formula for both those sections is, was there a gain under 357C? Yes.
This may be a dumb question, but how do we figure out if debt is in excess of the basis if we're not measuring the basis until 2 steps later?
You're measuring the base. Okay, so fair enough. This is the transferred property. Okay? This is shares received in exchange for transferred property. This is the transferred property received by Corp. So the debt in excess of basis is only being measured by the universe or population of the assets that are being transferred to the corporation. So the only asset in this case was land. So now the full population of stuff that's being transferred is land. So now I know the basis in the full population is 1,000. Then I know that either I have 1,001 of debt or 10,000 of debt. I measure that gain, and then I know this 1 or 9,000 goes into this formula to figure out the basis for the shares I received and the formula for the assets that are received by the corporation. So starting point, 351. Next stop, 357C. Then we go to 358, then we go to 362. Then we talk about 1223, 1 and 2, and 168 I-7, which I forgot. So 3 is kind of an ordering. I don't know if that's helpful or not. Jack, who do you want to call in?
Emma.
Emma? What's my note up there about?
This training raises awareness. A good practitioner knows the rules. A really good practitioner knows the exceptions. A great practitioner knows the exceptions to the exceptions.
Okay. We're just shooting for good right now. Right? We want to raise awareness. So what are the elements, Emma, of 351? Okay? And when I mean elements, Trent, why do we care about the elements? What's it help us do?
Diagnose.
Diagnose what?
Taxable or tax.
Whether it's taxable or tax deferred. So these 3 elements are helping you diagnose whether it's taxable or tax deferred. So you have to go down through these 3 elements and check the box of whether it's a yes or a no. And going down the list of checking whether it's a yes or no helps you to, Trent?
Diagnose.
Whether?
It's taxable or tax deferred.
Whether it's taxable or tax deferred. What are my 3 elements, Emma?
The taxpayer must transfer property to a corporation. The taxpayer must receive stock of the corporation in exchange for the property, in number 1 above. The taxpayer must have control or 80% of all classes of stock immediately after.
Okay? So let's take these in order. Because at the end of the day, 2 of these are, how could it not be? Did I transfer property? Yeah. Did I receive stock back solely in exchange? Yeah. The third one is the hard one. That's the one that you have to use to make a diagnosis of whether you have what, Trent?
Taxable or tax
Taxable or tax deferred. So let me ask a stupid question. Before we delve into control. Okay? Okay? So, stupid question. Emma, who you want to call in?
Jameson.
Jameson? Let me know when you're ready. You ready? Okay. 351, there were 3 elements, right? What were they?
Transfer to a corp. Receive stock from a corp.
Sold in exchange for stock.
Yes. And you have control or 80% immediately after.
Okay. Do you think that those rules apply equally to a brand new corporation and an existing corporation? Or do you think there's a different set of rules that might apply to a new corporation versus an existing corporation? So you and I decide that we're going to partner together in a new venture. You have ground, I have ground, we throw it into a corporation. That's new. I have a corporation, you have ground, we want to partner, and you put it into my corporation. That means that you put it into an existing corporation. Do you think the rules under 351 apply equally under a new corporation and an existing corporation?
I don't know.
You don't know? Who do you want to ask?
Jimmy.
Who?
Jimmy.
Jimmy, what do you think?
I think it depends.
It depends. Why do you think it depends, Jimmy?
I think it depends if it meets 368C. The last one. I don't know. I'll go with that on that one.
That's the right answer. You don't know. They apply equally. So you have to run the traps of those 3 elements, both for new and existing corporations. So if Jameson and I decide that we're going to partner together and we put our ground into a new corporation, do we both transfer property? Wayne?
I wasn't paying.
Jameson and I are going to partner together and form a corporation. She transfers ground, I transfer ground. She gets stock and I get stock. Did she transfer property? Did I transfer property? Did we both receive stock solely in exchange? And how much does Jameson and I combined as a transferring group own of this new corporation? Is 100% more than 80% or less than 80%? So that helped us diagnose it as taxable or tax deferred? Tax deferred. Yes.
So it's the transferring group. It's not. It can be either.
Say that again.
Like it can be just a taxpayer or it can be a group.
Yes.
Okay.
You're going to measure, in order to measure the 80%, and I think I get to this at some point, I think. My instinct is that I do, is that the transferring group, the people that are transferring property, is the group that you have to measure the 80% off of. So you and I were the transfers. We started a new corporation. We own 100%. That seems pretty clear. I own a corporation. You own ground. And your ground is worth $10,000 with $1,000 a basis because that's what we started with. You transfer your stock to the corporation and you get 50%. Did you transfer property? Yes. Did you get stock solely in exchange? Yes. Do you have control immediately after? You don't. And that helped us diagnose what, Trent? That it's taxable or tax deferred?
Tax deferred.
Jameson, taxable or tax deferred?
Taxable.
Taxable, because she didn't have control. Control is the key in the middle of this. Control is what, the first 2 elements are wild easy. Did you transfer property? Yes or no? Yeah. Did you receive stock solely in exchange? Yeah. Now you have to measure whether the transferring group that put the property into the corporation owns 80% of all classes of stock. Yeah.
Does it have to be at the exact same time?
What does that mean?
Like the group.
If you transferred on day 1 and I transferred on day 20, but it's all pursuant to a plan, and it's just administrative issues that we have to deal with. We're all measured as part of the same group because it's part of the overall same plan.
So if it's new, it's always gonna be tax deferred?
No. Okay, but, hold on, but Jack, 99.999% of the time, yes. So, what are we drinking from, Jimmy?
Fire.
Fire hose. So there's stuff that you're not going to know. There's always, what was that first note that we put up there, Emma?
We don't need to be expert.
No, the good practitioner
What'd you say?
I don't know.
knows the rules. A really good one knows the exception, and the really, really good one knows the exception to the exception. Okay? So, what Jack just asked is if it's a new corporation, is it always tax deferred? And Ben said,
Nope.
no. That gets into the good or great practitioner. The good practitioner knows these three elements, and the new is going to 99% of the time infer that you can diagnose it as
Tax deferred.
tax deferred and new. If it's existing, now you got to really hammer on this 80% control and who's my transferring group. Jimmy.
So you were saying that if Jameson had control, then it'd be tax deferred, but since she doesn't, it's taxable?
Yes. So if we change the fact pattern and she transfers the ground and she owns 80% of the company, all classes of stock, vote, value, every class, then yeah, that's tax deferred. So those three elements, what are the three elements again, Trent?
Transfer property, receive solely stock, and take control, which is over 80%.
Helps us diagnose, right? And control really is the problem or the thing that is the hardest concept of the three to button down and to understand.
Okay, so right now we're in a situation where for one more year we have taxes at the same rate, right? So at the end of 25, QBI goes away and our tax rates increase. So we're in a weird situation in 2025 where we might want to accelerate income. And so there might be certain clients with specific fact patterns where we say, hey, let's put your asset into a corporation and let's not meet these three rules of 351, thereby triggering the gain in 2025 so we can be taxed at a lower tax rate than if we carry forward the gain into future tax years. So there's great question by Jack.
And I have used that. I have intentionally failed 351 in order to make a taxable event. Yeah.
Question on that for Ben, I don't know if this relates to it. So would a lot of S Corps try going to be a C Corp then? Like would a lot of them try be classified as a C Corp?
So think about this rule is I am an individual and am putting an asset into a corporation. So I, the individual, am trying to trigger the gain, not in S Corp trying to intentionally convert to a C Corp.
Jameson, did you have a question? That looked like
Well, I just get confused when they say corporation, because is it a C Corp or an S Corp?
What's 1371 say?
They're the same.
All
Unless
rules
no-
apply equally till they don't. So 351 applies both to S corporations and C corporations. It's the 1300s are the rules that apply to S corps, but not to C. 1361, 1362, 1368, 1367, 1374, 1375. Those apply solely to S corps. There's every C corp applies to the S corp, but the S corp has its own exceptions. That's 95% true. That's true enough that I can say it with some confidence. Every C corp rule applies to S corp. There's certain rules for S corps that carve out exceptions solely for S corps. Somebody raise their hand. Yeah.
So if we contributed the land and then got stock but also cash, does that trigger a taxable event?
It does.
Okay.
Okay, and that's called boot.
Yep.
And somewhere in here, we have something about boot. Because that solely in exchange, because it literally says solely in exchange. But if, here's a fact pattern that you would see that question that Trent just brought up. Trent has land that has a fair market value of, I'm going to say 10,000. Okay? I have cash of 5,000. There's no way I'm going to let Trent be in control of this thing. Plus, I think the upside is too much that I want a 2/3, 1/3 split. 5 divided by 15 is 1/3, 10 divided by 15 is 1/3. So, where I've seen this come into play is both the cash and the land go into the corp. But my cash does a U-turn and comes out to Jimmy. So now Jimmy put in 10 and got 5 back. So now the corporation has 10,000 of value versus 15, and now I'm 50-50. I've seen cash be utilized to equalize the economics, come in and come out, and it's called boot. And that $5,000 that comes out as boot is a taxable transaction to Jimmy, who got not only stock, because the 3 elements are transfer property, solely exchange for stock, and have control immediately after. Well, cash coming out is not solely in exchange for stock. There's a provision in there that says if you have something coming out of the corporation, that's called boot, and to the extent that you get boot, you have to measure the taxability as if you sold or exchanged that portion of the property.
So you can include cash and it doesn't stop the rest of the steps.
Say that again.
Like in step 2 with the stock, if it was stock and cash, you still can move to step 3.
I still understand, I'm sorry.
Like, okay.
No, I'm not trying, so if somebody understands what you're saying, let's all work.
So if you go through the steps, you transferred property to the corp. So now you move on to step 2 because you're still in a tax deferral.
Well, but the property in my example, and I don't know if this answers your question, Sam, is cash and land.
Well, so if we're going through the steps, we'll do it for each. So
Right.
let's say the cash is Pete and I'm the land guy.
Fine.
Okay. So we have to go through all 3 steps for
To diagnose whether we have taxable or tax deferred.
right. And so step 1, we transfer property to a corp.
What's property?
Yes, Pete transferred cash, Ben transferred land to the corp. So now we're still in tax deferral.
Yep.
So then we go to step 2, must receive stock of the corp in exchange. Pete, did you receive stock? Yes. Ben, did you receive stock? Ben received stock and cash. So we're no longer in tax deferral mode for Ben.
Yeah, you are. Because I would split a hair with that. I agree and disagree at the same time. Okay. He got stock solely in exchange. We're still in tax deferral mode. And then you have to measure whether we had control immediately after. But the fact that he got this other item, this cash coming back to him, pushes the deferral aside because that's already been measured, because both of us transferred property, solely exchanged for stock, and we had control immediately after. But he got something else too. He got this cash. Now you have to measure, and cash is called boot. Now he got this boot, and now since he got this boot, you have to measure, he got something in exchange other than stock, and that portion of it now is taxable. I don't know if that answered your question or not.
My question was, it does. Like, I just wanted to make sure that you didn't stop the steps once cash came into play. Like something besides stock.
No, you have to use whatever that boot piece is and do a separate analysis on what that really means.
But you still do the analysis with the stock.
Yes, 100%. That's a great question. I didn't understand your question, but that's a great question. No, I just get confused easily.
So do I.
It, like you said, solely in exchange for stock. Well, I don't get that, because if, like, I got what he was saying, because he received two things.
But you continue it with the portion that was solely stock.
So two things can be true at the same time.
Yes.
Yeah, it's like a fork in the road.
You
Consider the cash separate from the
or it could be property, it could be land, it could be whatever. So the fact that we equalize the transaction, so we want to be 50-50 and something came out to equalize the transaction doesn't kill the tax deferred nature for everything. That's the point. But the thing that came out that's not stock, you have to measure the taxability of that. Did that get you there?
so it doesn't have to be cash, it can be property.
Yes. But the 99 times out of 100, it's cash. Jameson, what's this? Who you want to call in? I'll do it, Jameson. I don't know what you're going to say.
Pete, just read the example.
Yeah, let's see what we got.
Pete transfers land to Exco for 100 shares of Exco stock. So first, Pete transferred the property. Second, Pete got shares in the corp. And third, Pete owns 100%. So it's more than 80, so it's tax deferred.
Correct. All right, so let's see. What's this next page saying, Jameson? I don't even know. Like I said, I'm taking the guided tour with you guys.
Elements of 351 and 368. Transfer of property to a corp, transferring property receives stock, and the transferring group must have control as defined by 368 or 80% of all classes of stock.
Now we're going to start talking about control. What does control mean? Call on somebody, Jameson. You've been harassed enough.
Natalie?
I get confused between you two sometimes. Natalie, what's this say?
This is very tricky. This is a very tricky element when measuring 368C control. Seek advice from your manager or partner.
That seems like a cop out. Okay, let's see. Okay, so we have a sole transfer, Natalie, correct?
Yeah.
And Jack said earlier, Jack, 99 times out of 100, that's going to be tax deferred, right? Because it's a new corp. Jack, the middle one, I got more than one transfer, but it's going to a new corp. Still comfortable using that rule of thumb, Jack?
They both own over 80% afterwards, right?
Yep.
So yeah.
Okay. What about the third one, Jack?
I'm gonna seek advice from a partner.
Transfer groups.
Or a manager.
Well, so this says, okay, this infers both Pete and Jeff are transferring property to an existing corporation. That's what this is inferring. Okay, which means that both Pete and Jeff exist in the transferring group.
They're both over 80%, so yes.
Both over 80%. And then we have, oh, look at that. Dude, what's the last one on the bottom left of the page say, Jack?
Transfer to an existing corp that does not meet 368C.
So Pete only has 50%, right? 50% is more or less than 80%.
Less.
Less. So we fail, which means our diagnosis of the transfer of the corporation is taxable or tax deferred?
Taxable.
Taxable. So we measure the fair market value versus the basis, and whatever that difference is the gain that Pete has to endure because he engaged in a taxable transfer to a corporation.
I have a question.
Yeah.
On the third one, how can you transfer 100% in if it's already existing?
Well, you measure the transferring group. Who made a transfer to the corporation, Jameson? Pete. Transferring group. How much does Pete own? As a percentage.
50%.
How much does Jeff own?
50%.
Did both transfer?
Yeah.
So Pete's part of the transferring group, so that's 50%. Jeff's part of the transferring group, that's 50%. You add them together. So if 100% is more than 80%, therefore that transfer to the existing corporation met transfer of property, sold in exchange, and the transferring group had more than 80%. Therefore, it's tax deferred.
I think the question is, how is 100% available to be distributed to Pete and Jeff if it's an existing corp?
Well, if I have 100 shares and Jeff has 100 shares.
Right, but who had the shares before? It's existing.
Well, it's issued and authorized. The corporation has more shares to issue. So let's do it this way. Let's say that, in the bottom example, Jeff had 50 shares and Pete had 50 shares. Pete transferred property and he got 200 shares. So now he's at 250 and Jeff's at 50. And the corporation in its bank of shares had 250 shares to issue to Pete. Pete's the transferring group. 250 divided by 300 is, I think, more than 80%. Isn't it? Okay. I think it is. So since Pete had 250 shares at the end, 250 divided by 300, he now has more than 80%. Am I answering the question?
I don't think the question matters anymore.
Okay. No,
I'm just saying, I was just confused, but I really don't think it matters.
No, that's okay.
It would have made more sense if you had like Jameson on the side having like 10% and then each of them got 45%.
Does somebody want to point for the confusion?
Us. All of us.
I'm going to decline that one. Okay. Jack, who do you want to call on?
Lucas.
Lucas, what's my basic facts?
Basic facts are Pete owns a widget machine worth $750,000. The original acquisition cost was $1 million, and the accumulated depreciation is $600,000, which results in a net book value of $400,000.
Okay, scenario 1 says what?
Pete transfers the widget machine for 100 shares of XCO. Pete is the sole shareholder.
Okay. So how do we diagnose this transaction? And what are the elements?
So we've got taxpayer must transfer property to the corporation.
Okay. Did that happen?
It did. You gave him your widget machine.
Yep. Then what? The next element?
You receive stock from the corporation.
Yep.
And then do you control the thing? Well, it says you're the sole shareholder, so yeah.
So you diagnose it as taxable or tax deferred. Okay, calling somebody for number 2.
Jimmy.
Okay, if we transfer the widget machine to YCO, an existing corporation, in exchange for 100 shares of the corporation, 100 share represents 50% ownership in YCO. Is the transfer of the widget machine a tax deferred event or taxable event?
What do you think, Jimmy?
If you got 100 shares representing 50%, I would say it would be taxable.
Taxable, why?
Less than 80. You don't know.
The transferring group, which transferring group consists of who?
You and the existing corp.
Pete. I'm the people that are transferring property to the corp is transferring group. So Pete's the only party. Could be multiple parties, but in this case, the transferring group is Pete. So since the transferring group is Pete at the end only has 50% of the company. 50% happens to be less than 80%. Since it's less than 80%, it's diagnosed as what, Trent? Taxable. Okay, so that means, okay. What is one of my favorite definitions, Lane?
I don't know.
Definition of proceeds.
Debt
Wow, you're going to rattle off. Let's go.
debt relief,
Debt relief,
cash,
cash.
property.
Yeah, did you read it?
No.
Right there.
Oh, where? Oh, I actually didn't.
Okay. It's one of my favorite definitions of proceeds because people always forget about debt relief.
We learned it.
You learned it.
Awesome.
Yeah. Oh. You really want to make me quiz you on the last
No,
one, don't
no.
you? Because, I mean, that was just a little too... Okay, so the cash was 0. Property, which was stock received in the corporation, was 750. Debt relief was 0. Total proceeds is 750. Basis was 400. I have a $350,000 gain because it was diagnosed as a taxable event. Lucas, hold on, who did the last one?
Jimmy.
Who?
Jimmy.
Oh, who would you like calling, Jimmy?
Do Sam.
Hi, hey Sam. What's this say?
When property is transferred to a corporation, is it possible that it is encumbered? Is it possible that accounts payable could be transferred? Yes, it is possible.
Okay, so earlier I said the starting point was where, Sam?
350.
351. My next stop is where?
357.
357C. And why is my stop at 357C?
Because you have to see if there's a gain.
Because I have to see if there's a gain. Okay. So what's 2 say, Sam?
What happens if the debt transferred to a corporation exceeds basis of the assets transferred to the corporation? To the extent debt exceeds basis, the transferring shareholder will have a gain. Note, gain that results from 357C, debt in excess of basis, affects 358, basis in shares received, and 362, basis in property received by the corporation.
I think that's what I said earlier, right?
Yeah.
So highlighting that might not be a terrible thing. I mean, that seems like important enough that maybe, oh, and the reason I gave you Post-its, just so you know, was if you go, wow, this page might be important, you can put a Post-it on it. That's why we have those.